Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory, and the capital markets. Joining me for this segment, we have Luke Rahbari, CEO of Equity Armor Investments, as well as Joe Tigay, Managing Partner and Portfolio Manager at Equity Armor Investments. We're here to discuss the Fed's stance on tariff-driven uncertainty and how the VIX is responding to market activity. It's great to have the both of you with us. Welcome back to Trade Talks. And Luke, let's kick this off and try and make sense of some of what we're seeing here today and, of course, throughout the week. Tariffs are sparking uncertainty, markets are diving into risk-off mode, and recession fears are escalating. What did Powell's stance suggest when he spoke earlier this afternoon?
Thanks, Jill. Great to be with you again. I think his stance was very vague, and he did that on purpose. Mm-hmm. They tried to get him several times to say, so when do you think? What would it take for you to do X, Y, and Z? And he just didn't say. He said, we're very apolitical. We're just looking at the numbers. We continue to look at the numbers. There might be a recession. There might not, a slowdown. He said again that he wanted to get inflation down. So the market didn't hear a single thing that it wanted to. And then as you saw from the time he got on, it rallied it just a little bit. And then after that, it was just straight down. So he didn't say anything. He didn't commit to anything. And again, more uncertainty for the market. If the tariffs weren't enough, you see what's going on.
Yeah. Well, Joe, I think that's a smart strategy and prudent of Fed, for Powell to make those comments, because they are not a political institution. They're focused on economic data. They're focused on policy as relates to what they're trying to execute on. I don't think it would have made any sense or we would have been criticizing it in a different way if he was commenting on what the president is trying to execute on.
Yeah, I think if anything, it would have just added to the uncertainty. For the market's really just focused in on the jobs. Jobs are actually decent today, and inflation. That's really all the Fed is supposed to do, and that's all they can do. Beyond that, the market's really just looking at what are going to be the effects of the trade war. Does it go deeper? Does it cause any damage to the economy that's going to cause the stock market to fall even further?
Yeah. And Luke, let's step away for a moment and take the macro and take away tariff uncertainty for a moment. Valuations have been so high for quite some time. And we saw that with the European trade coming into the year, and why it was outperforming, because investors were looking for opportunities where the valuation was more attractive. So even with, and again, this is heightened volatility, the valuations needed to come in a bit anyway. So at some point, this is going to offer an opportunity.
Yeah, at some point it is. I mean, you and I have been doing this a long time, Jill, back all in the Chicago days, right? And I just want to go back over the long term. The S&P forward PE, let's say it's supposed to be around 15 to 17 times. The Nasdaq is supposed to be somewhere between 18 and 19. S&P a couple of weeks ago was 21, and the Nasdaq was even higher. So for us to get into a long-term range of where forward PEs have to be, I almost have to take a deep breath before I say it, but we're looking at lower numbers for both S&P, and we're looking for lower numbers for the NASDAQ. It really started with DeepSeek when they came out and just kind of had a very cheaper model, or so they said. All these valuations just went into haywire, and that was the start of it. So I think valuations do have to come down. Forward PE has to come down. We're looking at, I was talking to Joe and my partner Brian about our mutual funds and our portfolio. We're looking at, I think, Joe, correct me if I'm wrong, we're talking about NASDAQ around 13,000 for the PE that we're looking at, and S&P around 4,500. So that's a bit lower if you want to get to those historical averages. Now, if the Fed cuts and the stock market is a forward looking and they're saying, hey, PEs are coming down, maybe it doesn't go that low, but on a day like today, you really start to wonder.
Yeah. Well, Joe, let's continue to play devil's advocate here, right? There was so much liquidity in the system, such accommodative policy, right? And perhaps that fueled this valuation, that we saw, and why it's still, from a historical perspective, to Luke's point, there is still some room to get it back in line.
Yeah, there's some room to get it back in line, but unfortunately, that just means prices going lower, or the economy doing great and earnings going higher. Right now with the yields dropping so quickly, it's kind of signaling that a recession is coming. So that's when you get, we had the start of the year, we had a booming economy. Valuations usually overdo it to the upside in booming economies. Right now, unfortunately, we have a bear market. Valuations have a tendency to overdo it to the downside in bear markets. So that's where we're looking at this potential of a much lower Nasdaq just to get these valuations back in line. Unfortunately, the correction looks like it's happening in price. The best case scenario, Jill, is to have the valuations correct by time the stock market or the economy grows into the valuations. But when we have a slowing economy, that's what happened. Actually, if you look up, the VIX this morning was at 45, but if actually we bring up a chart that I have credit default swaps. This is just a sign of a massive fear of the economy slowing right now. We have credit default swaps rising. Bear perspective, we're not at 2020 levels. We had the whole world shutting down. We're not even at 2022 levels when we had the regional banking crisis, but we're rising very sharply. Another couple days like today, we'll be at the 2022 levels in these. A very palpable fear that a recession is coming soon because of the tariffs.
Yeah, and I'm going to take the other side of what I was saying before here, Luke. Even though, we saw what happened with the VIX and the spike in 2020, we knew what the reason was. We knew at some point there was going to be a resolution. Right. We knew there was so much accommodation that, the Fed had out there and other.
Going to be able to import export. I would say 50% going to be able to import export. I would say 50% of the Nasdaq names, maybe a little bit higher because of technology, whatever, but at least 50% of the Nasdaq names the Nasdaq names, 50% of their earnings come from overseas. Okay, that is troublesome. Where does Apple make iPhones? Where does Nike make shoes? Right? I mean, these are questions that you don't know the answer to, and it causes for a lot of uncertainty. And just another thing, just my favorite topic. For as long as you and I have been doing it, the market, for a long time, the market's been going up, and consistently for all those years, Janet Yellen had benchmarks. She said, if we get this, I might raise rates, et cetera, et cetera. We had them. She never raised rates. 14 years almost of a bull market and just lower rates every year. And now all of a sudden, what do you expect? Right?
Right. Yeah. I mean, it's almost like what's happening with the housing market. It was self-inflicted wounds in a way. Yeah. I mean, I benefited myself from, historically low interest rates, but that kind of also created that lock in supply because you have so many people that are under 4%. And do you really think that waiting to see these get to 3% again, if we get to 3%, if we cut rates that much, 5-6 rate cuts in a year, in my mind, that's a bigger issue, right, Luke? That's suggesting that the economy is under pressure.
Yeah, it absolutely means that, and it won't make housing more affordable because everything else would be so expensive.
Oh, that's a good point.
They're in a tough spot. I actually do agree with getting more fair trade. I do agree with the fact that fentanyl is coming into the country and it's a poison, and they've got to do something about it, both on the Canadian and Mexican side. They have to do something about it. This is one of the tools they're using. This isn't just about the market or trade. It's about national security, et cetera. So it gets a lot more complicated.
Right, it certainly does. And Joe, when you talk about national security, I think that's another issue when we talk about execution, how it is what's been working for the past, 80 years to nearly a century in terms of our alliances and so forth. What does that look like, not just from a national security perspective, but then how does that reshape the trade calculus as well? If I am, the CEO of a GM as an example, do I want to move all of my operations, which is capital intensive? It's probably going to take close to the end, of this administration's term. And the thinking is we might revert back to, what has been working as it relates to globalization, right? So it's a tough decision. It's a challenging operating environment for management teams that have exposure to the, these types of issues.
Yeah, 100%. That just adds to all the uncertainty. It's there's some manufacturing sites that just are near impossible to just shift so quickly, like you said. So it just adds to the uncertainty. It adds to the added costs of everything. And I think that kind of adds another dynamic to it that like not these this tariff proposal is still only a proposal. Nothing is set in stone as of yet. That's another thing that just makes it so challenging and makes it, I think it makes people more reliant on using some advanced tools, using some optionality, having a little bit more sophisticated approach to investing in this time, because yes, the risks are greater than normal, but the risks go both ways, Jill. The risk could be, a change in policy and we're chasing all-time highs again in a few months, or these go into effects and there's a domino effect that we're not really thinking about right now. So the risks are greater than normal, but they go both ways, and it just really looking over these investments.
It certainly does, and that goes back to the point I made at the beginning when thinking about valuations and why Europe was outperforming us in terms of equity performance, because the risk really was to the upside, right? When you're thinking about valuations and really getting to the core of the fundamentals of some of these European companies that were performing well. So that's an excellent point that you make. Things can switch on a dime.
I remember flying like during 2008, during COVID, and just like looking and saying, all these houses, everything I see under, people have to eat, electric things have to get moving. So I think it'll be rough for a while. Maybe valuations come down a little, but again, I'm going to have to go back to the big Nasdaq companies. Look at the balance sheets on these companies. They almost are going to love this. They're going to be able to get the workers they want. They're going to be able to swallow some other companies. Some of their competition is going to die off. Microsoft, Google, Amazon, Facebook, all the names all the names you love. I think they're going to benefit and come out stronger at the other end.
Yep. And exactly to Joe's point too, this is why portfolio diversification, long-term investing, this is a time to learn a lesson regarding that as well. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.
Yeah.